Okay, guys, so welcome to the class once again. So we're going to look at the trend tracker strategy, the TTS. So this is a strategy that is designed to follow the trend. So it's a combination of the basic trend analysis, which we've talked about extensively, together with the moving average and the momentum indicator, the RSI. So the essence of this strategy is to identify a trend, wait for correction, and trade the next impulse move in the direction of the trend. Okay, which is a very good way of trading the market because it allows you to aim for bigger rewards compared to the risk, okay, you're taking. For example, if you're going with like $10 risk, for example, you can get $20, $30, okay, if the price continues to trend and you're able to get in at a very good price level. So that's just the way to go, guys. You have to position yourself such a way that you don't have to win all of your trade before you can make good money. All right. So you don't have to win all of your trade. You don't have to have a very high winning rate. Right. If I ask some of you guys now, let me even ask you guys, what do you think should be the winning rate of before somebody can be successful? What do you think should be the winning rate before you can consider someone to be a successful trader? So let me get your responses. What do you think should be the winning rate? Let's say the person in a month has about 20 trades, for example. Out of these 20 trades, how many is he supposed to win for us to consider the person a good trader, a winning trader, a successful trader? Out of 20, like how many? Okay, for example. So let me get your responses. Okay, because winning rate is a very important aspect of trading. So oftentimes like this, when people come, one of the things when people come to the financial market to participate, to speculate in the financial market, one of the things that they want to know is, if I learn this strategy, what is going to be the winning rate? How many of my trades am I going to win? How many of it can I lose? Because definitely you know that you can't win all of your trades. So nobody has given me any response so far. What do you think should be the winning rate of a good trading strategy? So if you're putting 20 trades in a month, for example, out of these 20 trades, how many do you think should be won? Okay, so please write your response in the chat box. I've not gotten any response yet. Or is anybody hearing me? Are we all hearing me, or I'm talking to myself? Okay, so I've gotten the first response from God Bless. God Bless says 8 to 12 is okay. That means 8 to 12 wins out of 20 trades. Okay, thank you very much. Can we get any other response? So 8 is about 40% winning rate, and 12 out of 20 is like 60% winning rate. So God Bless is saying between 40% to 50% winning rate is good. All right. Yeah. So what about other people? What about other people? Please guys, respond. I need responses from you, from every one of you. Please try to participate. Just drop a message. Okay. Drop a message. So we need to know. It's really very important, because when it comes to learning strategy like this, always very good to talk about this thing. It's really very good to talk about it, because oftentimes when people learn strategies, they tend to they tend to over exaggerate those strategies, like in terms of expected performance, especially winning rates. All right. So once you are able to get through with that, okay, you won't have any problem. trading, because trading is a psychological game. Okay, it's a game of the mind, it's a business of the mind. So if you are able to tame your emotion, then you have a very big chance of becoming a successful trader. Okay. So far, I've still gotten just one response from everyone, just one person. I need rest before we continue. I have to get a response from like at least 4 people before we continue. Else, maybe we'll just have to close the meeting and maybe come next time when we are ready to respond. Please respond, okay? Very important to me, please. I need a response from you. So let me ask the question again. So we're talking about win rate. Win rate. Win rate has to do with, because definitely when we are trading, there are some trades we're going to win, and there are some trades that we are going to lose. Definitely we can't win all. So the question now is, for you, for one to be a good trader, a successful trader, what do you think is supposed to be the winning rate? So let's say out of 20 trades, how many should be a winner? How many wins? How many losses? How many wins? How many losses? That's what I'm saying. They have God bless says 8 to 12 wins out of 20 is good, right? Which now means like also 8 to 12 losses. So that means 8 to 12 wins out of 20 is good according to God bless. So I'm not asking other people, what do you think? But I'm yet to get any response from us. Okay, thank you, SN. Finally, I get somebody. So I have, let me put this as God bless. And I have SN. So SN says 10 to 15, right? 10 to 15. And I have Abidemi says, Abidemi says 15 wins out of 20 is okay. Okay, 15 is okay. And I have Ezenwata says 7 out of 10. Ezenwata says 7 to 10, right? That if you can get 7 to 10 wins, you'll do fine. I have Quadri. Quadri says, sorry if I didn't write you guys' name very well. Say minimum of 12 wins. Okay, that's minimum 12. That means greater or equal to 12. And it says the losses must not be more than 8. So which means that if you lose more than 8, according to Quadri, you are doing very, very bad. Okay, um, we're going to see if that is true or not. Okay, thank you very much. Those of you who responded, I appreciate that. Okay, 5 people, cool. Okay, so we have 5 samples here, not bad. So what we're talking about is for you to call yourself a good trader, a successful trader, what should be your win rate? If you have 20 trades, how many of it should you win? All right. So God blesses 8 to 10. SN says 10 to 15. Abidemi says you should win 15. And Eze and Water says 7 to 10. And Kadri says at least you should win 12. Okay, so I have Emmanuel also. Emmanuel Ahmed says 5 to 10. Is that not very low? 5. If you win 5, Emmanuel, if you win 5 out of 20 trades, you win 5, you lose 15. Do you think you can be able to handle that? Emmanuel, answer that. Will you be able to handle that? Okay, but let's just look at this. Now, when it comes to trading, there are 2 things that we need to understand very well. There are 2 major parameters that can affect your overall result. The first thing is the win rate. That means out of all the trades you are taking, how many of them are winning and how many of them are losing. Very important. And then the second thing, which is also very important, is the risk to reward ratio, RRR. All right. The risk to reward ratio is also very important. It's just that a lot of people focus more or mostly on the win rate while ignoring the risk to reward ratio. Do you know that it is possible to win 18 trades out of 20 and still lose? And still lose overall. Do you know it's possible that you will count all your winners, there are 18, and all your losers are you had only 2 losers, but the 2 losers, the 2 trades that you lost, they weigh much more. I mean, they weigh more in value than the 18 that you win. It's possible, all right, because of this risk reward ratio. And it's also possible, we've seen people who win 3 out of 20 trades. That's very low anyway. Not everybody can handle that kind of win rate. So we have people who win 3 and lose 17, but they were profitable. All right. Those are just extremes. Extremes. It's really, really very tough for anybody to win 18 out of 20. Okay. And it's really, really very tough too for somebody to win 3 out of 17. I mean, to win 3 trades and lose 17. All right. Especially if you have a very good strategy that you're using. So these two are kind of extremes. But one thing you are going to notice is, okay, let's talk about the risk reward. What that means is that for every $1 you are risking, how much are you making back? For every $1 that you lose, how much are you making back? Okay. So if you are losing $1 and making back $3, so that means you don't actually need a very high winning rate. Okay, you don't need to win at least 12. Okay, you don't need to win as much as 15 before you can be profitable. You don't need that. If for every $1 you are risking, you are making $3 back. Okay, so the higher the winning rates, the higher the risk reward you are making use of, the lower your winning rate. As the risk reward tends to go higher, your winning rate tends to come lower. It's just a natural thing that happens to everybody. So the person that wins 3 trades and lose 17 trades, perhaps his risk reward is about 1 to 10. Yes, we have people like that who are risking $1 to make $10. Okay. Yeah, we have people like that. So if you are risking $1 to make $10, that means if you win 3 out of 20 trades, you will be profitable. Okay. But if you are making just every time you make, you're just making $1, $1.5, $1.2, $2 when you make profit, all those small profit. But when you now lose, you lose maybe $20. Yeah. When you lose $20, but you are making $1, $1.5, you just make many profit like that, but they are tiny. And then when you now lose, your loss is very big. If that happens, it means that even if you win 18 out of 20 trades, you can still lose. All right. I don't know if we need to really break that one down for us very well. Okay, maybe we should just look at example. So let's say there is somebody, let's look at 2 people. Let's look at A and B. So every time A risk $1, he's trying to make $3 back. But B, when B is winning, when B is making $1, okay, he's also losing like $9. So at the end of the day, let's say B, let's say the 2 of them have 20 trades at the end of the month, for example. And let's say because this one is just making tiny profit and big losses, it's going to have high winning rates, right? It's going to win more trades than it's losing. Okay. He might even, out of 20, might even win like 17. okay, or let's even say 18 and lose just 2. Okay, so if you multiply all the tiny wins, it will have made how much? $18. And then if you look at the 2 big losses, it will have lost how much? $18. What happened? 0. Didn't make anything. Meanwhile, he won 18 and lost what? 2 trades. That's a very big winning rate, right? Yeah, that's like 18 divided by 20. That should be like 90%. Yeah, that's 90% winning rate. And with despite the high winning rate, it still didn't really make any money. All right. So, but this other guy, let's say out of 20 trades, he won 8. Just like let's say the person that is in water who wins between 7 and 10. Let's say in the particular month he won 8, and of course 12 losses. Okay, so that means he's losing $1. So the loss is like minus 12. And every time he makes money, he's making $3. So the wins is what? 24. So at the end of the month, he's making $12. Or let's say 12% rather. All right, 12% or $12 or something. So this one makes money, despite the fact that he lost more trades than he won. But this other guy won so many, and then those 2 trades just crashed all the profit they made. Now we have a lot of beginning traders, amateur traders. Let me just put it that way. Pardon me. They like trading this way. They believe that the number of winners that they have is what is important. Okay, so at the end of the day, it's either they are losing money or they're not making money at all. While the professional traders understand that they need to make big wins, all right? They need to make big wins and also keep their winning rate at a sustainable level, all right? So that's what is important. So anytime you are talking about trading performance and all that, you need to always consider these two, okay? You need to always consider these two. Now, somebody winning, the question you are going to ask me is it not possible for somebody to win 18 and lose 2 and still maintain a high risk reward? That's almost like impossible to achieve. That is really, really, if that happens in a particular month, that's like a luck. We have people, let's say the first trading month, let me clean all of this. Let's say the person started trading in January, and then the person, let's say he wins 15 and lost 5, despite the fact that he had 1 to 3 risk reward. Now that's a massive, mind-blowing result there. 1 3 risk and you win 15 and lose 5. That's massive, mind-blowing result. Now, because you achieve that in a particular month does not mean it's going to always happen like that. Don't be surprised if in the following month you win 6 and lose 14. And maybe in the next month you win 10 and lose 10. It's just going to be very, very, it's going to vary. It's a kind of distribution. Okay. So if you have this kind of winning rates and this big risk, just know that it's a lucky month, and you're going to have some month where the result is never going to be as close as that. Okay. The rest of the month are never going to be as close as that. So you need to understand that that's just the way the market works. Now, professional traders, what they do is that they understand these 2 things and they know how to manage it. And that is how you can make money consistently. Now, all that I've been saying so far is for people, it's not for people who want to make money. To make money in the market is not difficult. Okay, you can just open your MT4, close your eyes, pick a trade, and click buy. And if you're lucky, you can make money. Okay, that doesn't require skill. Trading to make money in the Forex market does not really require skill. If you are lucky, fine. You can place 2 trades and win the 2 of them big. Luck. And if you're not lucky, you lose the money, you lose your money, or you lose a large part of it. So, but what I'm talking about here is for people who want to be conscious of what they are doing, who want to maintain profitable performance consistently, not just one time this thing, you know, it's not just one time show. It's that they are making the money, they are making profit consciously and consistently, okay, as a result of the effort they are putting in, not just luck, okay, but as a result of their effort, their skill, all right, and their real performance. So those are the people I'm talking about now. So because I'm saying this now, somebody might say, there is one guy in my place who just open one account, something, and he just plays something and just makes so much money like that. Okay, things like that happen, and it's as a result of luck. Okay, if you are lucky, cool. Okay, but those of you who want to do better than just being lucky, okay, who want to be making money monthly, yearly, on a consistent basis, even become fund managers and all that. So those are the people I'm talking about. And so those are people that we call professional traders, okay, experienced and professional traders. So people like that, they understand that win rate is not the only thing that they need to understand when it comes to performance metric. Also very important is the risk reward ratio. Okay, always note these two. Okay, they are very important and you can't take one and ignore the other. All right, so that's it, guys. So having said that, now I hope having said that, we all agree with what I talked about. Okay, if we don't agree, don't worry, when you start trading, you will you will agree with what I am saying. Okay, that's if you have not been trading before. But for those of you who have been trading, you will agree with me 100% that what I'm saying is true. Okay, now, so having said all of this now, guys, it's now very important for us to not get ourselves so much fixed on how many of my trades am I winning. You don't have to win 70%, 80%, 90% of your trade before you can make money. All right, you don't have to. Professional traders don't do that. I don't do that. Nobody does that. No professional profitable trader does that. All right, it's not going to happen that you're going to be winning 90% of your trade every time, every month. No, forget about that. Just if you're having that kind of thought, remove it from your mind. Unless you want to be making $1, $1, $1, $1, while your risk level is around $20. Unless that, it's only people like that that have that very big win rate, okay, because their stop loss is so far away and they're picking small profit. And the day that it doesn't go in their favor, the day they are not able to pick that $1 before the price goes against them, let me tell you, all the profit is gone. Yeah. Okay. All the profit is gone. In fact, some of the capital will go with it. Okay. So forget about the idea of, very, very massive high winning rate. Just forget about that. Okay. Okay. So that's cool. Okay. Now, so having said that, now let's now go to the strategy we want to learn today. So that now means that, let me put a disclaimer that the strategy you are going to learn does not win all the time. Okay, it doesn't win all the time. According to what the calculation I've done, the strategy wins about 40 to 50%. Okay, 40 to 50% on 1 to 3 risk reward. For those of you who were in the last class, we did the back testing together, okay, for some time. So it wins 40 to 50% on 1 to 3 risk reward. Okay, for example, let's say in a month you're able to get 12 trades, okay, and you are targeting 1 to 3 risk reward. If you like, you can actually aim less than that. That's going to increase your winning rate. Let's say if you slow down your own to 1.2, 1 to 2 risk reward, you might actually increase your winning rate to maybe 55, 60%. Okay, if we are going for this, I think this is the average you're going to get month on month over a large period of time. So let's say you have 12 trades in a month, and you risk, let's say 3%, for example. So if you win 40, let's say you're going to win 5 trades and you're going to lose like 7. Okay. Or you're going to win 4 and lose 8. That's like the average you can get, either of the two. So the day when you have a little bit above the average, you have 5 wins, which is going to be the loss is first. Every loss is 2% loss. Let's say, okay, 3%. Let's say you're risking 3%, okay, which to me is kind of high. So that means you're going to lose 21% of your capital for all the losing trades, okay, using this example. But for the winners, every win is going to be 9%. Every winner is going to be 9% for you. Multiply that by 5, so you have plus 45. All right. And when you remove the loser from the winners, you have plus 24% at the end of the month. So if you risk 3%, all right. If you like, you can go 5%, but those are really, really too high. Okay, those are really, really too high. They are just too aggressive. Okay, so let's say it's 4. That's going to be 9 times 4, 36, and 3 times 8, 24. If you subtract them, that's about 12%. So the result is going to range from here, okay, between here and here and here and here for most months, okay. So so that's it, okay. So you need to understand how the performance can be, okay, before you even start learning it, okay. So that somebody is teaching you a strategy does not mean that it's a kind of holy grail that that is perfect, right? Okay, so let's now go in there now. Let's go talk about it. Okay, so for this strategy, it's a trend following one, and we aim to look for a trending market and join the immediate trend at the end of the correction. You know, I told you guys when we were looking at trend analysis that this is how the trend moves. Where's my drawing tool now? That price moves like this, up, down, up, down, up, down, and all that when it's moving in a downward trend. So when it's doing that, the best way for you to trade is to wait for these corrections and sell. Wait for this correction and sell. All right. Maybe even correction, we can grab this one too and sell. Okay. And that's what this strategy is going to do for us. Or if the price is going upwards, the price is going upwards like this in an upward trend, making higher highs and higher lows like this. So what this strategy is going to give to us is to identify this correction, bearish correction, the end of it, and buy, the end of it, and buy. Okay, so that's what the strategy is going to do for us, and we are going to make use of 3 different tools. So the first tool we use is the moving averages, while the second one is the relative strength index, and then we're going to use the third one, which is the trend line. All right, so which is the trend line. So let's go further. All right, so now we're going to make use of the moving average in 2 ways. Number one, we're going to use it as a trend determiner. We're actually going to make use of 3 different moving averages, right? 3 different moving averages. The first one is the 200 moving average. The second one is the 250, and the third one is 300 exponential moving averages. So these 3 moving averages being run together will serve for 2 purposes. The first one is a trend scanner. So this is how the moving average is going to look on the chart. This is a 1 minute, 1 hour chart. So this is how it's going to look like. I see 3 different moving averages. This is I'd say this is 200, 250, 300. Okay, just different colors for them. So the first use of this moving average, okay, let's call this moving average band, okay, because we have 3. together. So we can call it a moving average band, the three of them. Okay, so the first thing is the first thing you want to see the moving average do is to help you determine the trend. How? If the price breaks above the band, it means we are in an upward trend and we are only going to be looking at buying. All right, we're not looking at buying opportunities. And also when the price breaks below, we are looking at a downtrend and we are going to be what? Selling. Okay, so that's the first thing. Help us to identify the trend. Okay, now the second thing is when price breaks, when price breaks out of the trend like this, it's an established trend. And when we're in a trend, what are we looking for? We look for correction so that we can buy. So after price breaks above the band, we say that we're in an uptrend. So next thing we're going to wait for is the price to come back to the band, touch any of these band, whether the three of them or one or just a little bit below, just a little bit, and then quickly push up. If you have something like this, then we can say this is the end of this correction, and then we can look for a buying opportunity. Okay, so we can use the band to identify end of a correction. Use the band to determine the start of a trend. Use the band to identify end of a correction. Okay, so that's the second way. Okay, likewise, when the price breaks below here, which is a downward trend, we wait for the band to correct. I mean, the price to correct back to the band to confirm a correction. And then once there's a reaction downwards, then we can sell. Okay, so that's it. I hope we are following. I hope it's quite simple, especially if you were in the last class. Okay, you're in the last class. Okay, so this is the example again. You see a good break. It has to be a really, really good break with several candles below the band. All right, several candles below the band. That's a very, very good break. Okay, and so this is the other one here. So you have price break. I've already explained this. So the first thing you say break to identify a trend, then you wait for a correction to the band. And then the band can offer a kind of resistance here. You know, I told us in the last class that we can use the moving average as, I mean, for support and resistance. So here, the moving average is acting as a resistance level. Okay, so we see a break below. Bearish trend is established with several candles below the moving average band. And then you now see a corrective bounce to the moving average band. And so if it's able to offer some kind of resistance and price start to drop, that's going to be a selling opportunity, okay, to continue the bearish trend. All right. Another example here for the bullish market. So price breaks above the band. This is the first thing, breakout. Then the bearish trend is the bullish trend is established, which means we have several candles above here, above the band, and then price now makes correction to the band and bounces off it, and then that will be a bullish opportunity. So two things there: identify the trend after price breaks away from the band, and then the band serving as a correction when price makes a retracement or correction to it. Okay, so those are the two ways we are going to be making use of this moving average. Okay, this moving average band. Okay, so the second one we're going to look at, or maybe before we go further, maybe I should just show us how we can do that on the MetaTrader 4. All right, so I'm going to share my MetaTrader 4 with us now, so that we can see how we can do it on the MetaTrader 4. So let's go. Let's check. Okay, I hope you cannot see my MetaTrader 4, right? If you can see my MetaTrader 4, please drop a message for me if you can see my MetaTrader 4. So this is my MetaTrader 4. I'm on the Euro US dollar currency pair. All right. So let's draw our moving average. So the first, let's go here. This is where we have the indicator, trend, moving average. Then we can start with the 200 exponential. We can make that black. Okay, see that? And then we can also go for 250. And then we can choose red for this one. Okay. And then we can also go for 300. Maybe we'll choose blue for that. So you can see the band now, which means that once price breaks above it, like here, it means that we're in an upward trend and we're only going to be waiting for price to make correction here before we buy, correction here before we buy, correction here before we buy. All right. This is a very good example here. You can see our price broke below it here. You can see the break below here, and we have several candles to confirm the trend, and then price now makes correction back to the band. And what happens afterwards? See multiple falls. You can see our price fell. That's our price fell there. Another example is here. You see price break below here, make some correction, but this is a kind of sideways. But let's look at the better example. The price continued the bearish trend and came here and then got some resistance there and then dropped down. Okay. Another example here, this is a very good example. Price broke upwards with several candles up, makes correction to the band and then shoots up. Okay, that's a buying opportunity there. And I think another one here as well. Breakdown, pull back to the to the band, and then price drop down. So that's just what I'm talking about. Okay, so we use the band to identify the trend, and then we can also use the band for support and resistance. Okay, for the end of corrections. Okay, so let's now look at the second indicator. Okay, the second indicator we're going to use is the RSI. Okay, we're going to make use of the 70-30 overbought and oversold settings. Okay, for those of you who can still remember, when we actually talked about the momentum indicator in the last class, and let me share what's with you guys. And what we said, okay, was that for momentum indicator generally, a lot of traders, or let me say the default education that everybody got when it comes to a momentum indicator is the concept of overbought and oversold. Okay, which means that when the price is going up, the indicator can help us identify when the upward move, or this upward move, when it has become overstretched. Okay, when the price has become overbought, all right, overvalued. So the indicator that helps us to know that is the momentum indicator. So the momentum indicator are usually constructed between 0 and 100. And so once the price is getting towards 100, let's say it's from 70 to 100, it means that this price has turned to overbought, all right, and we'll be expecting it to drop. Likewise, when the price is going down consistently, you're going to see the momentum indicator coming down to the lower boundary, okay, which is okay, a lot of people use 30 and 100, 30 and 0. Okay, why this one they use 70 to 100, 30 to 0. So the price comes here, if the indicator comes, it means this is an oversold and price is likely to now push up, okay, because it has become oversold. And that's if you take it like this, just at this face value, you're going to get a whole lot of false trades, false signals, and I give us a lot of example Please check that video for revision. Okay, false signals. And I say that for us to limit the number of false signals we get, it's important that we use it in a different way. Okay, which means that instead of us to just use it like that, okay, we can actually use this RSI, or let's say momentum indicators, overbought oversold concept. We can actually use it to identify the end of a correction. Okay, because we discovered that the momentum indicators, the signals they give, the overbought oversold signal is very weak when we are trying to use it to identify the end of a trend, or the bottom of a downward trend, or the top of an upward trend. But it's really, really very powerful when we use it to identify the end of a correction. Let's say price is going up and now makes a correction. So we can use the indicator to help us identify the end of this correction by looking at whether the indicator has gotten to the oversold. If the indicator has gotten to the oversold for the end of a bearish correction like this, then it's actually very powerful. Okay, the same way, if the price is going down in the downward trend and is making a correction, we can use the momentum indicator overbought signal, okay, to help us identify the end of this and the price drop downwards. We talked about that, right? So that's the way we're going to use it here. So that means when you have your band this way and you have the price, and then you have the price moving this way in red, and the price breaks below here. So that's the first time price has broken below to give us a downward trend. So what we're going to look forward to is a correction back to this place. Okay, but when the price gets here, we can't really say exactly that when it gets here, it will start turning back to identify the end of the correction. Okay, sometimes it gets there, sometimes it doesn't get there, sometimes it overshoots the zone, the band. Okay, so but one way for us to at least reduce the number of false signals that we get there is to also check the momentum indicator. Okay, if price has gotten to here, and then you also have the momentum indicator giving us overbought conditions, then we can start looking for a sell, right? And also, if the price breaks upwards, we're going to wait for a correction, bearish correction. So when we get this, when the price enter into this, whether it touches here or here, once it enters into the zone, you're also going to look for oversold situation on the momentum indicator. I prefer the RSI in this condition. In this, I prefer the RSI. So I want to see the RSI at 30, between 0 and 30. Okay, at 30 or less, equal or less than 30. Okay, so once the RSI gets there, then you can look for a buying opportunity. Okay, so that's what we're going to use the RSI for. Okay, that's what we're going to use it for. Very easy. And so you can see this indicator here. You can see how the RSI is able to identify end of bearish correction. It is a bullish trend, and you can see the corrections. When price comes, you can see how the RSI came to the oversold condition. And at the end of once the RSI got here, what happened? Price shoots up. We had another correction here. You can see it here. Price shoots up. Another correction here. You can see here. Price shoots up. So this is a very, very good example of the RSI identifying end of corrections. Okay, so these are oversold readings from 30 downwards. So, and also when the price is going downwards, also in a bearish trend, we're going to make use of the RSI overbought conditions to identify the end of corrections. Okay, as you can see here, price moved down, make a correction here. We have the RSI touch down. It goes down again. First correction to this place, RSI here, and it goes down again. You can see that. Okay, so these ones are just that. We only have 2 examples here. Okay, although price made a lot of pullbacks. Okay, but these ones are the most significant. Okay, among them, and that's what the RSI helps us to pick very, very easily. So the RSI reading for overbought start from 70. So from 70 to 100. All right. Okay, so that's it. Now, the third thing we want to make use of is a trend line. So let's say all those conditions have been filled. How do we now confirm when to enter? Okay, let's say we have the band, the momentum, the moving average band has already identified a trend for us. And also the band, also, I mean, correction has come and it has touched the band. And we have been able to confirm that correction with the RSI. So RSI is at, let's say, the overbought or oversold reading. So how do we now confirm when to enter? Okay, there are actually two ways you can do that. The first one is to draw a trend line, the closest trend line possible. I already showed us how we can draw trend lines. The closest trend line possible, just draw it and wait for price to break just one candle close above it. Okay, if it's in a bullish trend, and then once you see that buy, set stop loss below the correction. And if it's here, for example, okay, if it's here, you draw this trend line, price breaks below it, you sell, and then you put your stop loss here. All right. So that's one way. The second way, okay, which I didn't actually mention in the last class, is by using price momentum divergence. I told us how many of you were in the class when we discussed the price momentum divergence? How many of you were in the class? If you're in the class, please signify. So talk about the price momentum divergence, whereby price is going up, making higher highs, and then normally when it's making higher highs, the momentum is also expected. Okay, let's say this is the price making higher highs. The indicator, okay, which let's say the RSI is also making higher highs. But we're going to get a divergence when this one makes a lower high. Okay, or let's say, okay, not that. Let's say this one makes a higher high and the indicator makes a lower high at the top. So making a higher high, indicator makes a lower high. That's what we call a divergence. And that is a sign that price is about to turn the reverse. Okay, it means that price is about to reverse. So the same thing when we are in the downward trend, price is making lower lows. It's also very expected that the momentum is making lower lows. But the low, when we get the divergence, you're going to see the momentum having a higher low. So it's making a lower low and this one is making a higher low. Now that's what we call a divergence. So once you see divergence and you see price making the first response to the divergence, you can also buy, right? Buy. So those are the two entry methods by using trend line break or divergence, price momentum divergence to confirm when to enter. Once we get that, we just enter, we'll put our stop loss below or above the correction, okay, whichever case it is. And so that's it. We're going to look at some examples very soon, don't worry. So now what about the target? So the way we do the target is, it all depends. I recommend 1 to 3 risk reward, okay, which means that you have to, before you can know your target, you have to know your stop loss first. You have to know your stop loss in terms of pips. Let's say this is an example, and price broke above this trend line. We have an entry here. Put our stop loss here, and you calculate between the entry and the stop loss, that's 50 pips. That's going to be risk in terms of pips. Then your reward, if you want to maintain 1 to 3 risk reward, just multiply 50 by 3. So that means your profit, your take profit is going to be what? 150 pips. So with that, you have maintained a 1 to 3 risk reward. All right. And if it is 30, let's say the stop loss is 30, then your target is going to be what? 90 pips. If it is 25, your target is going to be 75 pips and so on. Okay, so that's if you are using 1 to 3 risk reward. Okay, so let's put everything together before we look at some examples. So step by step, number one, the first thing you're going to do is to plot your three moving averages and then your momentum indicator, especially the RSI. So you can do that on a 1 hour time frame. Okay. Although this strategy is useful for multiple time frames, okay, but 1 hour is very, very good for the moving average readings that we have. Number two, the bullish trend happens if price breaks and stay above the moving average band, while the bearish trend happens if price breaks and is below the moving average band. So if we have a bullish trend, we're going to be looking at bullish trades. If we have a bearish trend, we're going to be looking at a bearish trade. So number three, you wait for retracement to the moving average band. Okay, whether that's the 200 to the 50, the 250 or the 300, or maybe slightly above or below them. Okay, so a minor break above the band is also useful. So discard the retracement if the price sufficiently breaks the band. So if, let's say, this is the band, price break below, and instead of making a correction here, it breaks above it again. Okay, we're going to discard. This is not going to be an opportunity. Okay, we're looking for a case whereby when price breaks here, it corrects to this place and then turn downwards. All right, and then it turn downwards. So that's the case we are looking for. But if instead price breaks away significantly, then definitely we're not going to look for a sell opportunity. If that happens, if this happens, that means we're not going to look for a retracement back here and a buy. Okay, so that's what I'm trying to say here. Discard the retracement if the price sufficiently breaks the band. There are some times that, let's say this is the band and price breaks up. Okay, that's like the band. So let's say this is the band. And let's say the price breaks it and makes a correction, but the correction slightly breaks below and quickly turn back. This is allowed. All right. What we don't want to see is a sufficient and sustained break. All right. You don't want to see that. So number four, confirm retracement with exhaustion. Okay. Confirm retracement, end of retracement with RSI 70. If it's a bullish retracement, I mean, if it's a bearish retracement, you use RSI 30 and below. All right. Buy or sell at the break of the retracement trend line. So once you do that, you plot your trend line or you use your divergence. At the end of the bearish retracement trend line, blah, 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 blah. All right. So target triple of the trade risk. So it's just everything that I've talked to you guys about in words. That's what we have there. Let's look at some examples before I take us into the chart. To look at what happened here, this currency pair, Australian dollar, US dollar, 1 hour time frame, price broke below here and makes a retracement back to this place. So when the retracement happened, we have the RSI at 70, okay, which makes this correction valid. So for us to get an entry, we need to plot the closest trend line possible. And so we're able to get this good trend line, connecting these three lows, 1, 2, 3, connecting them, and price broke below it, and then we have our sell. Stop loss here, sell here, and target here. That's 1 to 3. Okay, that's one example of this this strategy. Another example is this: your price broke above, and look at this place, makes a correction here. We'll have bought here, right? But why didn't we buy? Because the RSI couldn't confirm 30. All right, so you have to watch the RSI. The RSI needs to be at least at 30, you need to touch this 30 line, okay, if we are going to buy. But because it didn't touch it, we couldn't buy. But eventually price slightly broke below and quickly pushed up. So at that time, we already have the RSI touch here, and then we could then get engaged in a buying position when price broke above the trend line, very close trend line, and then price went up. Okay, so those are just the two examples I want to show us on the PowerPoint. So let's now get into the chart and see if we can get more, especially if we can apply the divergence as well. So can we all see my MT4? I've switched to the MT4. I hope we can see my MT4. If you can see my MT4, please let me know. Drop a message for me. Or let me see if you can't see it. Always let me know. So we have this indicator, the RSI, and then we have this one here, the stochastic. Now I'm going to remove this stochastic because I want to use only the RSI, but I'm also going to use the MACD. I like using the MACD for divergence. Okay, now it's talked about divergence. So if we have the case of a divergence for an entry instead of a trend line, of course, we can make use of a divergence. So let's see some examples. Now, this is the Euro US dollar. And what happened? This is not really a very good example. We didn't really see a sustained break. Let me look for a very good example. Okay, this is an example here. Okay, but not, look at what happened here. Price broke above the band, makes a correction back to the band. But what happened here? The RSI didn't touch 70. The RSI is very strict. Okay, very, very strict. I didn't mean we use the stochastic, we will have been able to get oversold on the stochastic. All right. So, but we use the RSI because the really is really, really very strict and it doesn't give signals all the time like that. Okay, maybe we should switch to let me save this as a template. Okay, let's just switch to let's look at Australian dollar, US dollar. Now, this is a strategy that doesn't give you so many signals. Yeah, it doesn't give you so many signals. So you have to use it on many time frames. I mean, on you have to trade many instruments. It allows you to trade many instruments because it doesn't really on a particular currency pair. It might give you 1 or 2 trades in 1 month on the currency pair. So that means you need to get like 10, 15 currency pairs to trade so that you can get more trades. So let me save this as my default. Okay, so this is Australian dollar USD. So let's see if we can get some examples here. Now look at this example here. Price broke below here. That's the first thing. Then it makes a retracement to this place. And what happens here? Yeah. Cool, right? Then you just plot your trend line. And price broke below the trend line, then we have a sell. So I'm going to have my sell right here. And my take profit is going to be right here. Then I can target times 3. That's going to be like maybe like 40 pips or thereabout. And I can target much more than that, maybe like 120 or so. Okay, and it'll have actually given that. Another example here, price broke downwards, continue downwards and make a retracement here and quickly come down. And you're going to see one thing here for this one. Of course, we can have a trend line entry by plotting these 2 trend line. And when price broke, we sell. Or we can have a divergence with price making like a double top or maybe a higher high here. And what happened to the momentum indicators making a lower high. Okay, so that is that. Okay, so that's it, an example where the entry signal is gotten from the price momentum divergence. Okay, but you're not going to get divergence every time, so you can always make use of your trend line. So you can see this is a sell signal, this is a sell signal, and price just continues to go downwards. Okay, so that's examples on Aussie dollar. We couldn't really get anyone here. Price broke upwards. Really very strict indicator RSI. It makes a correction here, but we didn't really get a touch of here. Fortunately, at the end, but price pushed up. Okay, so but it's all okay. So we can check as many examples as we want. So what we want to do tomorrow is to do what we call back testing. Okay, so we are going to do more back testing on this. So what I did today was just to explain the method to you, all right, so that you can see how it works. So please make sure you watch this video again and learn about the method. And then tomorrow we're going to do some practicing. We're going to check on the charts, all right, and then do some back testing. Okay, so I have a question from Chinese. Says, why don't we use stochastic? Well, like I said the other day, that when you use stochastic, you are going to have more signals, right? And when you have more signals, of course, you're also going to have more losing trades, more winning trades and more losing trades. So if you are somebody that is very conservative with the number of trades, use the RSI. If somebody that want more, use the stochastic. Okay, so it's, I can't really say one is better, one is not better. So they all have what they are. I mean, the RSI is very, very strict. It won't pick. There are some good trades it will not pick for you, while there are also some bad trades to help you to avoid. And then stochastic is going to pick those good trades, but it will also rush you into bad trades. So you said, can you use RSI and MACD? No, you can't use them together, okay, for this purpose, because each of them will give you signal at different time. And I said also in the last class that the RSI and the MACD, the RSI, okay, you're talking about MACD. Can you use RSI and MACD? No, I think for overbought and oversold, you use RSI or stochastic. Okay, why you can use your MACD for divergence. You can also use MACD for, okay, you can also use RSI and stochastic for divergence as well. So for divergence, it's good to have two indicators there, so that if one doesn't spot divergence, the other one will spot it. So like the example we gave, like this example here, this one spot the divergence, right? What about this one? It did as well. Spot the divergence as well. You can see the line here. There's a particular setting I like using for this. I think it's not 513.1 or something. Let me see. 513 that will remove. Okay, that's 513.1. So it's going to make the signal line and the histogram to merge, unlike the other one that they're just scattered. So you can see, you can use 531 as well. You can see that we're able to get a divergence here. Divergence for the two. But the reason why I like adding MACD to any of these signals just for divergence, just to confirm, to double check, because there are sometimes RSI might not pick divergence, but if MACD picks it, is all good. Okay. And even this one that didn't even give us any divergence, I'm sure if you look at the lower time frame, let's say you now go to 15 minutes now, you might actually get the divergence for it. Let me see if this chart can take me there. That's 12:14. I don't know why my internet is not loading up the chart. I'm supposed to load up the chart so that I can see. So what I'm just trying to say there is, even if you can't find divergence on this time frame, you can check the lower time frame, 15 minutes, to confirm the divergence. I'm sure you're most likely going to see divergence here. All right, on let's say the 15-minute time frame. All right. So the setting for the RSI is 14. 14, RSI 14, and then 70 for the overbought and 30 for oversold level. All right, for the RSI. You want to use the stochastic. The settings for stochastic is, I like using 10-3-3. All right. And if you want to use the MACD, the settings for that is 5-13-1. All right. I like using 5-13-1. Is it 513.1? Say 3. Okay, 513.1 is actually good. All right. Okay, so that those are the different indicator settings for this. Okay, now that's just one method. Okay, it doesn't really mean that if you know that you are, because you might actually be missing traits here. Okay, you of course does not really have to use the band. You want to get more traits, don't want to, because the band is just to support you. All right, to support you. It's easier to read with the band, but without the band, but with the band, you are going to, there are some traits you're going to miss, definitely. All right, there are some traits you're going to miss, but you can also just remove the band and then check for those trends with your naked eye. Of course, you know how a trend looks like, and then you know this is a correction, and then you can just use this one to spot the end of the correction, and then look for divergence or trend line break, and then go. All right. Okay, or if you want to use the stochastic, if you want to use the stochastic, then I advise that you confirm with divergence every time, because the stochastic is really, really very fast. Okay, for example, let's use the stochastic so that you see what I'm talking about. Okay, so oscillator, stochastic. So that's going to be 2575. Or to make it strict, to make it at least stricter, you can use 2080. All right. So it's going to increase those over both over sold level. And 1033 is good. Use OK. And all right. So your job is just to look for a trend and correction. Like here you have a trend and then you have a correction. Then at the end of the correction, you make sure that the stochastic gets to over above 80, and then you confirm entry with your divergence. Let me see if I can get a very good example. If you can't find divergence here, we can go to a lower time frame. Like here now, we can have it. We can see that price is on a trend, up, down, up. This is the correction. You can see this correction here. Stochastic was able to spot it, but the RSI it's quite slower than that. It's not going to spot it. RSI is able to spot it here. And pushed up here. And pushed up. Okay. So I think we should just focus on 80-20 if we're going to use stochastic, and also try to confirm with divergence, whether on this time frame or on a lower time frame. Okay, let me give us an example of a lower time frame divergence. Let me look for where it's quite close. Okay, look at this one now. Price makes it was just break. You can see the way price is moving up, down, break of structure here. And this is the last low. Price didn't really get there, makes this correction. And here we can confirm the end of the correction, and with the stochastic giving us sign here. You can see that. All right. So you can look for more confirmation that this has ended on the by using the 15-minute divergence. So this is 1 hour. So let me mark this place and let's look at it on the 15-minute. We're going to see divergence there. Okay, I don't think we're able to see a very visible divergence. Maybe on the 5-minute, but I'm not sure it can give us up to 5 minutes on this chart. I don't know. Okay, we're able to get 5 minutes. No divergence. Not really divergence like that. Okay, so but all these things, okay, maybe there's a divergence. All right, I think there's a divergence here on the stochastic. I see we get a divergence on stochastic, but we didn't get any divergence on the MACD. See that? What about the RSI? We didn't get a divergence as well. So it's always good to have 2 or 3 indicators. So we have a divergence here to confirm, and then we'll have been able to find an entry for this. So it's all just boiled down to practicing. Okay, just practice. You guys have to practice. No, I'm only telling you, but you have to see it for yourself. You have to apply it. You have to do a lot of testing like this, back testing, check here and there, to see how these things work. Okay, so Do we have any questions? Anybody with any more questions? So we have come to the end of this class. So tomorrow we're going to do backtesting session. Okay, where we're going to apply these things in real time. Now we can see how they work better. Okay. So I'm not, what I just did tonight was that I'm not trying to confine us to the fact that you have to use moving average or stuff like that. But what I'm just trying to build, what I'm trying to give to us is a concept of trend analysis, okay, by using indicators to spot the end of the correction. Okay, we said that you can use the moving average when it breaks above the moving average, that's an uptrend. When it breaks below, that's a downtrend. But you know that definitely it does not have to be like that. That's just for people who don't understand trend analysis. All right. If you understand trend analysis based on all the things we have talked about, you don't have to use moving average. You can just focus on analysis of the trend, high, lows, break of structure, how the trend is being maintained, the start of a correction, the end of a correction, all those stuffs that we talked about. Okay. So Mr. Iberi said, will it not be a confusion if conflicting signal for the two indicators are just illustrated? No, it won't lead to it won't lead to it. Okay, what I just talked about here is you using divergence. See, divergence on all of them are the same. Divergence is divergence. Divergence is divergence, but just that there are sometimes an indicator gives you divergence, another one does not give you. Okay, so if you are using want to use divergence, all right, you can check on multiple momentum indicators, and the three most popular are these: RSI, MACD, stochastic. So if the RSI doesn't give you, the MACD can give you. But remember that these things are mathematical formulas. Okay, these things are derived from mathematical. I mean, price from price numbers, price data. Okay, so it's still all boiled down to practicing. Okay, you have to practice. Definitely, you have to practice and practice. Okay, there's no two other way about it, because if you don't practice, that's when you can get confused. Like here, the two of them give us divergence. Like here, you can see it is on divergence, divergence, divergence. Okay, but there are some times that it's only like one or two that we give us, so you can always use any one of them. I would think it's going to confuse you. Just put one there. Just put maybe the RSI or anyone. Just put it there. Just use anything that is very simple. Trading should be very, very simple. Okay. If you think that having more than one indicator is going to confuse you, just focus on one. If the RSI, if it's whatever, just focus on it. Okay. So having multiple indicator does not guarantee that you are going to win all of your trades. Because oftentimes there are some times that, because we don't want to lose trade, we keep on adjusting and adjusting and adjusting. Let's say you place this trade today, it doesn't win, and you say, "Oh, let me adjust again." You adjust. No matter how you adjust, okay, you're going to win. You're going to win trades and you're going to lose trades. So it's inevitable. So I have a question from Mary. Says, is divergence the formation of momentum at the overbought or oversold region? Yeah. Divergence can be anywhere normally, whether at the middle of the indicator or at the overbought or oversold region. But the best of divergence is at the overbought or oversold region. Okay. Based on even the concept we are looking at it from, because we are trying to use the divergence to identify the end of correction. Okay. And if we are doing that, so that means we have to see the momentum indicator get to those extreme levels for us to even confirm that the correction has ended before we now look for divergence. So one comes before the other. We have to confirm that the correction has ended, okay, by looking at the overbought or oversold first before we now look at divergence, okay, for entry. Divergence is just for entry, just shows that our price might start falling down from there or going up, depending on of which trend you are looking at. Okay. So do we have any more questions? Okay, if there are no more questions, please, we are going to meet again tomorrow tomorrow we're going to do a lot of back testing, a lot of adjustments here and there. I mean, not really adjustment anyways, just we're going to do so much back testing, okay, so that you guys will see. But like I said earlier, I don't want to force this on us. I've already given us those tools. Okay, this is just the way I put them together. Okay, you can put them together in some other ways that can even be, maybe better than this. All right, that's convenient for you. Remember, trading is um, you against the market, not all of us against the market. Okay, so you have to choose your own fight very well and use something that is very, very convenient for you and that can also make you money consistently as well. All right. So thank you very much, guys. Thank you. I'm going to see you tomorrow's class.